So I've been in the fintech space almost 8 to 9 years. I grew up in Bangalore, did my undergraduation here at Christ University, and then worked for about 6 to 7 years in my family business, which was into apparel textile manufacturing. So I spent a lot of time on the factory shop floor, did nothing in financial services for the first half of my life. Um, and then actually went abroad to do my MBA at Stanford, which is where I met my co-founder Shashank. Long story short, we came back in 2014 and decided to start up something in lending. We looked at various options, different businesses, and within financial services, we looked at SME lending, consumer lending, everything, right, that you can think of. We looked at in 2014, got an NBFC, and that's really how we started the business. Uh, First few years were awesome. Then ran into some major headwinds in 2019-20 with ILFS, COVID, bunch of our own kind of internal issues. Had to really reset the business almost for about 3 to 4 years. And now we are finally, after going through lots of ups and downs, pivots, some great learnings, we are now completely focused on the consumer credit space, where we have two products. One is buy now, pay later, where we are acquiring customers online by partnering with large merchants, Amazon being our biggest. And the second is basically personal loans. And obviously, the entire USP of the business is how do you acquire customers quickly online for free, give them credit in a few seconds while they are shopping, but obviously maintain risk and loss rates, and then cross sell them and upsell them other products, right? So what Bajaj has done very well for 20 years in the offline world, we and along with many others are trying to do it in the online world. Uh, and it's been like I said, it's been an interesting journey. We have about 8.5 million customers today, adding about 200,000 customers every month, doing almost about 600 crores of loans every month, and maintaining, since most of you are from fintech and lending, maintaining loss rates or default rates at or about the 2% mark for the better part of the last 3 to 4 years. That's me, and that's Axio. Uh, Time, since this is about my journey, I think that's what Suchi wanted me to chat about. Rather than telling you everything that we've done well, unwell, or going to focus on three or four big mistakes I've made in my journey, right? Because I think most of the time in the startup world, you end up hearing about things that have always gone well. Uh, Journeys are obviously never linear. People do make a lot of mistakes, some intentionally, some unintentionally, and you learn from those mistakes. And so I'll talk about, since you guys obviously have your own businesses and are kind of getting into that journey of growing the businesses, I'll just tell you three, four mistakes that I made, and how we actually got out of those mistakes as well, if that helps, right? And then we can just leave it open to any kind of question and answers. Um, so guys, the first mistake that we made in the journey of Axio is, um, like a lot of founders, we were filled with energy and filled with FOMO, right? We thought as founders we could do everything. And there was always this insecurity and fear of missing out. And I think what happened because of that is we ended up doing too many products and diversifying too much as a business very, very early on, right? So within the first couple of years of our business, we were doing SME loans, we were doing some part of consumer loans, we were doing loans to Kirana stores, we were doing loans to Uber and Ola taxi drivers. We had like six different customer segments. We had two, three products under each customer segment, right? And this was a business that was just about 2 to 3 years old. Everything seemed well and great for the first couple of years, but when the tide gets tough, that's when you really know where you actually stand, right? And so as and when the ILFS crisis happened and liquidity was really sucked out of the system, that's when we got caught unaware, right? Defaults started to rise. We had not really understood our customer segment very well. We had not understood, very honestly, risk underwriting collections, which is the heart and soul of this business. We had not understood it well enough because we were dealing with so many customer segments, right? We just wanted to do the hot, sexy thing that everyone was trying to do. We would get FOMO if one of our competitors was doing something else, and so we would jump and start that product as well. So I think long story short, first mistake is, if the one thing that I can tell you, at least in the first few years of your business, try to stay as focused as possible. It may lead to slower growth in the early years, but that's fine, right? Once you get that fit, once you get that customer segment, once you understand that piece, then business can really grow well. So from about 2020, around the middle of COVID, we ditched a whole bunch of things, picked one customer segment, one product, one partner, and just scaled with that. And 3 years later, business is performing the best it's ever been. Um, and that focus and having the entire organization, the entire both sets of co-founders looking and feeling and just one product and one customer segment has made a huge difference in not only how we run the business, but how we understand our customer segment, how we understand risk, how we understand collections, and the nuts and bolts of the business. Um, that's one big learning that I've had. The second one is, early on, I think in our Series A timeframe, which is around 14, 15, yeah, I think closer to 2015. Again, everyone likes to raise as much money as possible, right? I think we raised probably one of the larger Series A rounds during that time, around 2015-16. It was a 13 million or 14 million Series A, which I know nowadays doesn't mean much, but back then it was a pretty sizable round. And we ended up diluting a sizable percentage of the company. I think, if I remember rightly, it was almost 25-30% in that one round itself, right? And that's a dilution that we have never been able to recover from, right? So no matter how well we did later on, how valuation rose, it crashed, it rose again. I think that level of dilution we've not been able to recover from as founders. And if I look back at it, I would have taken a much smaller round, maybe 5-6 million, and had a much larger stake in my own company today than I have, right? Obviously, I love where we are today, but I would have left to me, I would have kind of loved to, have a little bit more ownership. As you know, most startup founders are like in single digits, right? And that's not a place that I think any of us should be as you look back on your journey, 5 to 7 years uh, in the rearview mirror. So while all the other rounds were good and great, I think this is the one round where I think we could have been a little bit more thoughtful and again not kind of just gone with what the market wanted us to do. Um, the third thing is, you know, again, this will sound very cliche and very topical right now, is build a business that is sustainably profitable, right? We did not do this. I'm being very honest, right? We, like most startups, we focused just on growth. We did not understand the unit economics very well of the business early on. Both Shashank and I were not from a lending background, which was good in certain ways because we could challenge the status quo. But it also took us some time to understand how lending actually works, right? And so it took us a while to build a profitable business. And because of that, we could never control our destiny, right? We ended up needing capital frequently to scale. And that again leads me back to my dilution point, right? So I know all of us as founders have this inherent need to just keep growing top line and look at revenue and make things as sexy as possible. But at the end of the day, the business has to be sustainable. We all have learned it in the hard way. And as you're seeing what the market is kind of telling startups today, I wish somebody had kind of I told us this early on. And I know it sounds like a stupid thing that business should be profitable, but how early in your evolution you need to get there, I think that's something that we had actually underestimated. And the fourth kind of thing is, again, as startup founders, business becomes our life, right? We work, we work, we work. I'm sure we all have families, kids, etc. And again, work-life balance sounds like a cliche. It sounds like something that's never achievable. But in the first like 4-5 years, I would spend a lot of time working, right? Not much time with my wife. I had one kid then, I have 3 kids now, but not much time focusing on my health. Uh, and so when business got tough around 1920, right, it took a real toll on my health, right? I had put on almost 15-20 kgs. I was not healthy. I was eating terribly. Stress was up the wazoo, like you couldn't control stress, which led to high BP, all of that stuff that comes with bad habits, bad eating, lack of sleep, stress at business, right? And at that point, I decided to kind of one fine morning, I decided towards 2021, I decided to just change my lifestyle completely. Um, in college days, I was a pretty decent athlete. I got back into athletics. I started training for a triathlon, for Ironman, and spent a lot of time, training almost 10 to 12 hours every week for my triathlon journey. And what that did to me was phenomenal in terms of how my life bounced back, but also how I would actually turn up excited and energized to the office every day. And in many ways, I think the turnaround that we've had at Axio Capital Float over the last couple of years has been in large part thanks to the way I've kind of thought about the business, delivered at the business, because of what I've had to kind of because of my journey in terms of my physical transformation and my approach towards health and my approach towards my triathlon journey. And if I were to credit something, I think I'd give that a large credit in terms of the turnaround that we've had in the last 2, 3 years in our business, right? So don't ignore that piece of your life in terms of the balance, in terms of the health. And I know, like I said, all this sounds like cliche, but trust me, I've spent hours, weeks, months, years in this journey. The highs are very high, the lows are very low, and you need something outside work that actually kind of counterbalances some of this stuff. That's me. Like I said, I don't want to spend too much time talking. I'd rather keep this as interactive as possible. Feel free to ask me any questions and let me know how I can be helpful.
Great. Thanks a lot, Gaurav. I think that was very honest and from the heart. Really, really appreciate it. I'm sure there is no one in this room, who has not able to relate to what you have all shared. Yeah, interestingly, I also started I have also run my own manufacturing business for 5 years, making paper bags. And it really taught me the power of credit.
Yeah.
Like once you know how to sell to retailers and wholesalers, you honestly know how to do everything else.
Yeah. When you spend time on a factory shop floor, I think the grounding and humility that gives you, I think that is the best learning that you can ever get.
Correct. Correct. Absolutely. Great. Guys, please open up. I mean, just raise your hand. Feel free, ask questions.
I put one question in chat. So thanks, Gaurav. Thanks for sharing your learnings. Could you please also share some learning during those times of headwinds? Because I believe you were required to do some pivoting also. So what actually transpired and what are the key learnings from there?
Yeah, so like I said, right, before ILFS and COVID, we were a multi-product lender. We were doing SME, we were doing consumer, we were doing taxi drivers, we were doing everything you could think of, you've kind of done it, right? So we didn't have the resources, honestly, uh, once ILFS happened. Once COVID happened, that made it even more difficult because, as you'll remember, during the first phase of COVID, the RBI said that we had to pay back all our lenders, but borrowers were given a moratorium, right? So we were in a very bit of a cash crunch and a squeeze. So the one thing that we did, obviously, the hard decision that we first took was obviously we had to cut costs, which meant that we had to do a certain amount of layoffs. The second thing that we did was cut the number of products that we had, right? Because we had to choose what we thought was actually going to become big. And so we chose consumer and we chose buy now, pay later and our partnership with Amazon. Though at that point in time, it was the smallest business we had, but we still ended up choosing that because we had to actually place a bet on the future. And in hindsight, the bet worked out well. And so it was a bit of a gut call. And we stopped doing, SME financing. We stopped doing few other products. But we were forced to pick and choose one product where we had the resources from a people availability point and from a lending standpoint. The third thing that we started to, because all of you are in lending, obviously, we had to kind of, move from just being our own balance sheet lender to a larger part being through off book, through co-lending with banks and BFCs, all of that stuff, right? So that was something we also did to kind of shore up liquidity and so change the business model in that sense. And finally, what we did is towards the end of 2021, we actually took the hard bullet of taking recapping the business, taking a round and raising money at a lower valuation to make sure we had enough balance sheet firepower and strength. And a lot of companies are doing it today, but we did it a year and a half, 2 years ago. And took the hard path of saying, okay, we are going to take money because the company needs it. We are going to do it at a lower valuation, and so be it. But we did it for what we thought was, the right next steps in the business.
I have one more question and slightly personal. If you want, you can avoid the question and refuse to answer also. You
Yes.
come from a very reputed business family of good means. Did that help at the time of setting up a business because of the financial support and the obviously the connects of the family and other support systems available in the family?
No, so if your question is, did it help in fundraising? No, it did not help in fundraising, right? We went outside, we went to VC investors, and we got money from equity investors outside. At the first round, when we got a term sheet from outside investors, at that point of time, some of the family did put in money, but it was never a case where we got money from family, launched the business, and then actually took money from outside investors. That was never the case. It was the other way around, where at least I was very clear, the family was very clear that we need to kind of do this on our own, prove our mettle, get a term sheet from outside, and then the family kind of added on. And even since then, the family has been like a sub 1%, 2% shareholder in the business, right? So it's been a very, very minority, like I said, sub 2% for since the start of the business, right? So the family is, I think, been more of a supporter in terms of my abilities as a founder, coaching, a lot of learning from my father and uncles. But from a financial support, it's been very minuscule.
And any other business support you think does these things helps, or we should completely move out of the existing comfort zone or ecosystem?
See, I mean, I'm being very candid. We have a HNI co-lending marketplace, right? Where we raise NCDs from HNIs, right? I think in that piece of the business, having good networks within our communities, that has definitely helped kind of get NCDs and raise debt for the company. Again, not a financial support, but just having a good reputation and backing. I don't think there's any harm in kind of leveraging your existing networks. In fact, you should. Um, but I would always say find a way to keep a arm's length distance, and there should be no related party transactions, right? Because then integrity and things like that can get questioned.
Great, Gaurav. I think, like taking a down round early on, I think it's something a lot of I've seen founders are very wary to do. Even today, the funding scenario is so bad. So why is it? I mean, is it a stigma that, I
Of
mean,
course it is, right? Of course it
what
is a
is, yeah,
stigma. Nobody
correct.
nobody wants to
Hmm,
kind of take a down round. Nobody wants to look at a lower
right.
valuation, right? Everybody wants to become a unicorn in the next 6 months, 12 months, 15 months. But I mean, yeah,
Yeah,
I'm proud of people who do that, but that's not the reality for everyone, right? And some
got it.
people are going to have hard journeys, and at the end of the day, like, I mean, we've seen some of our competitors in the recent times just bail on businesses. That's never been our attitude. We have been very clear that we will stick, we will do what it takes, see the company through the hard times, no matter what that is, right? Yeah, you're going to take a down round, you're going to lose more of your company, you're going to have higher dilution, but at the end of the day, you're fighting for a worthy cause. You're fighting to build a large business, a successful business. And this is, in some ways, part of just those building blocks, right? So I think as we see the times are tough right now, I think if a lot of founders stick on to the fact that they will never do a down round or recap the business, I honestly think that's a mistake. If you can get away with that, well and good. But at some point, you got to leave your ego at the door.
So, yeah, hi. Hi, Gaurav. We are an MBFC too. We are into education financing, fee financing. So far, we've been bootstrapped. So my question is like we have approached, a couple of VCs, and being an MBFC and the raw material being money, they've been telling that like it's very hard to scale, because money is the one with what's the will be able to rotate. So I mean, how can we counter these kind of questions like how like
There's no easy answer to that, Vikram. You have to, first step is you have to figure out and get somebody to bite the bullet, right? Somebody has to write you that first check, because
yeah.
you're in a business where money is raw material, right? If you cannot give a loan, then like this just not going to happen. You could start off as a marketplace and get co-lenders to come and do all of that stuff, and maybe that's the right place to start. But at the end of the day, I think if you're in the lending business, you need to have the ability to build some amount of balance sheet and be able to take risks. So you have to figure out what that is, right? So whether it's a small check, whether it's, figuring out how do you actually even raise debt on some level of equity so you can start to lend out. Uh, that's probably the only way to do it. VCs right now are definitely a bit wary about lending generally, right? Given that there could be a credit cycle and stuff coming. So I would say that the best bet is maybe start as a marketplace, and have enough money to give first loss guarantees to your lenders. But outside of that, I don't see any other way other than kind of just working and finding someone who can write you the first check where you can get a first few loans out, or scale those loans, right?
Thanks, Gaurav.
But we should chat, Vikram. There
Yeah,
are
yeah,
certain
I'll
things we can do
connect you
together.
once.
So
Okay,
my
go ahead.
question was, Gaurav, that initially, as you mentioned, that you had spread yourself through thin with multiple partnerships initially, which became problematic, and you lost focus on that one segment. But now that you have, eliminated some of those side products or products that were not giving good results, do you think now to grow further, the better effort to reward ratio will come from growing your own loan book through your own distribution? Or do you think now it would make sense to explore certain partnerships as well so that you can grow the loan book faster?
So I think we are very candidly about a year away from doing a lot of it through our own distribution. I think in the short run, we will still obviously work with a lot of partners and do buy now pay later through our merchant partners. But we are already starting to kind of sow the seeds and build the infrastructure to be able to manage our own distribution. See, I mean, having your own distribution sounds all great when you put it on a pitch deck and stuff like that, but that distribution comes at a massive cost, right? Today, CACs, customer acquisition cost for like a loan, right? Whether it's your own app, whether you do it on Google, Facebook, anywhere, is like 3-4%, 5%, sometimes going all the way up to 6%, right? It's very, very, very expensive. And the problem with your own distribution and lending is this problem of adverse select, where you typically end up getting customers who are looking for a loan who should not be the ones taking a loan, right? And so it's very hard to kind of build that. It takes a lot of time. So that said, we have already started going down that path, but it'll take us some more time till we can actually build it out fully.
Yeah, just wondering what your thoughts are on ONDC, how you guys are looking at it. We talked a little bit about it with the ONDC team earlier
Yeah.
this week, so curious.
Yeah. Actually, funnily enough, we just spoke to them day before yesterday as well. So, see, I think
Okay.
I think there are two pieces to the ONDC piece, right? How they're thinking about the e-commerce side of transactions, where a lender like us can actually come and empower those transactions by providing credit. And then there's the credit marketplace itself that they are doing, right? I think the credit marketplace is an easy start and is the right place to start, because it's more products for customers are more vanilla. You can get a lot of large lenders like banks, NBFCs, etc., coming in there. The question is, how effective is it going to be, and how do you really attract customers through the buyer side apps there, right? Because a lot of these buyer side apps anywhere are building their own kind of marketplaces with back-end lenders and stuff like that. So how is it really going to be different, I think, is a question mark. But I'm honestly a little bit more excited on the e-commerce side of things. It's a harder problem to solve, but I think with much higher reward, if at least from a selfish perspective, a lender like us can plug in our BNPL stack and empower credit for those transactions that are happening on ONDC, I think that's pretty interesting.
Gaurav, like you mentioned about the dilution, right? You said that it's good Mandeep is not here, otherwise she would be cribbing from the VC side. The 25% was too much, right, at that time. So what is the kind of advice, like a lot of people will be in their journey. Like
Yeah,
there is no formula to it, okay, how much should I dilute? So
there
any
isn't,
advice you would like
there
to
isn't, but
share? Yeah.
typically, like again, from my past learnings, I would say in the early rounds, seed, series A, etc., you shouldn't look to dilute more than 15, maybe max 20%, right? Our dilution was closer to 30 in that round, right? So I think take a lower round, take a lower valuation, whatever it is, but try not to dilute the 15-20%, because you won't realize it then, because at that point it'll seem minuscule. You're like, okay, I'm going from like a 85% shareholder to like a 70% shareholder, but that drop gets more and more exaggerated as you actually raise further rounds.
Great. Thanks. Thanks for sharing that.
So yeah, I'm guessing across your journey, you've gone through multiple pivots, right? Like I'm guessing the one key thing is that while as a founder, we make mistakes. I'm guilty of making few myself also. The idea is that it's very difficult for the team to align, right? Like from one to another, right? Like, and that's where if you could highlight on how you transitioned that, because more than anything, there is inertia there, if I'm not wrong, suddenly.
Yeah, no, that's a great question, Ruchi. So, the honest answer is that when we had to do certain round of exits in 1920, uh, a bunch of folks actually left us because they did not align with what the new plan or the new vision was, and we were okay with that. But folks that were there at slightly, mid to junior levels, who were at the company almost from the start, are the ones who really kind of were there for us then, and they are still there for us now, right? These are the guys who obviously understood the nuts and bolts of the businesses because they spent all their time actually building it out themselves with their own hands. But they are the ones who also kind of were ready to give us a shot and say, okay, let's roll the dice together. And today, it's those folks who are holding all the senior positions in the company, right? Our head of product has been with us for 7, 8 years now, right from the start. Our head of finance, CFO Akshay, has been with us for like 6, 7 years. Our head of collections has been with us 7 years. Uh, our VP strategy has been with us for 6 years. Our head of HR has been with us 7 years, right? So these were all folks who were very new, very young when they joined us, have all risen through the ranks. Our head of sales also has been now 7 years. So our entire core team and the top management of 10 people, I think the average vintage will be 6, 7 years, which is not very common in most startups. Right. And if I look at the top 100 people in the company, at least 50% would have crossed 5 years. So I think some of it is just kind of explaining to people, yeah, and being honest, saying that, okay, yeah, we are going through some turbulence. This is the bet we are making, and this is what we are going to do. And either you're on board or you're not on board. And if you're not on board, that's fine. Like, let's part ways happily. There's no problem about that, right? Nobody's here to work for their entire life, right? Let's be honest. If you get 5 to 10 years out of someone in this day and age, I think you should be really happy.
Gaurav, I'll move to my next question. Like now today you're doing 600 crores, let's say a month in BNPL. Have you ever considered that I should move back into SME? Because this is something I understood I was doing well. You were integrated with Metro Cash and Carry. A lot of players, you were there. Yeah.
Yeah,
So,
yeah. Not right now. The answer is not right now, right? Again, like I said, we have obviously, the business has been looking very good for the last couple of years, 2, 3 years. But I don't think we are there yet where I can confidently say that, yeah, we are profitable now, but I don't think we can confidently say that we are at a point where we can start to diversify and get into other product lines, other customer segments, etc. I think we've built a decent, good franchise over the last few years in focusing on one customer segment. And I'd like to see the journey through at least for another couple of years and expand that. And, in some ways, God has been kind in the last 2, 3 years because the regulator, creditors, etc., have made it hard for some of our competitors.
right.
And so, in buy now pay later, especially the competitive landscape has thinned out quite significantly, right? And we are kind of in some ways last man standing, and so it's kind of ours to lose. So I want to double down that focus, in fact, right now in what we are doing, and just make sure that we are there to kind of win that segment.
Hey, hi, Gaurav.
Yeah.
So, can you talk a little bit about if I can say so, the struggles that you had while trying to balance the, personal side of life and professional side, get the work-life balance, and how did you overcome it? Because as founders, we always think that like the FOMO kicks in, right? Even if we are not working, even if we are not into the work, we're still thinking about the work. And sometimes we kind of in our head weigh in, okay, is this important or is this important? And then we end up by default choosing the work. And like in hindsight, when we look back, we felt that, okay, that was not the right decision. So how did you overcome it?
Yeah, I think, first is the mindset change. That mindset has got to change. That, if you're going to be working 24/7, you cannot focus on your health and stuff like that because that's not going to last. We all are here to run our businesses for the next 20, 30 years, right? It's not like a sprint that we are going to do for 5 years, build like a mega unicorn, sell it. 1 out of 100 people may do that, but let's be honest, like 95% of the people are not able to do that, right? So this is like a long journey, and in India, nothing happens before 10 years, right? At the 10-year mark is where you actually start to see some magic, right? So you have to be able to ready yourself for a very, very long journey. And so first you have to have that mind shift change that if I am healthy, business is going to be healthy. That is just the bottom line. But more importantly, more than the physical health, it's the mental health, right? When I started working out more, when I was able to do my races, so I do one Ironman race every year. I typically sync up my fitness and Ironman goals to my business goals. What that means is this year, like last year, when I did my Ironman, which was not last year, sorry, last month, I had certain goals in the business, and I try to time them in such a way that okay, I'm going to achieve these two, three business goals by the time I'm going to achieve my Ironman goals, right? And that really helps keep me excited, motivated at work, and it helps me kind of make sure that both are going in sync. I don't want to making sure I end up achieving my business goals, but my fitness and Ironman goals are never achieved, right? I ensure that balance has been kind of created by me, although hypothetically for no reason, but it's kind of gotten to a point where now one doesn't exist without the other. Now I know my goals, fitness goals for the next year, and I know that in the month I want to do my iron race, I have one or two key kind of business goals. So that has to really happen. To just throw the damn phone at night. Like there is nothing that cannot wait for the morning, right? Switch off WhatsApp, Slack also, like after 9 p.m., like I don't see messages. So like beyond a point, just switch off the phone. Uh, Third is you got to have like a support system, right? And I was lucky that, my wife is also heavily into fitness. She runs a couple of kind of fitness studios, gyms, etc. Right? So it was very encouraging to have your spouse, or if that's not the spouse, it could be anybody else within your close circle that is also on a similar kind of journey from a fitness perspective, on a health perspective. Now, it need not be fitness; it can be anything that is just makes you a healthier person, right? I think that was also very helpful.
We'll be seeing more fitness from Anurag now. I think the next Iron Man, you will find him next to you.
No,
Would love to. Would love to.
not yeah, not just fitness, but I completely was able to relate. So I have been an entrepreneur for almost 11 years now, and I completely understood the priority changes that keeps happening in our head, and how the as simple as taking a 20 minutes walk, becomes last priority, and then you start regretting the next day morning, and the cycle continues.
Yeah, and when you suddenly switch off and do that 20-minute walk, 30-minute walk, do it continuously for 1 month, you will see that the output at work becomes much better. It's just natural, right? And then you start to really enjoy work, right? There were days during COVID I didn't want to show up at the office. It was hard to come to office, right? And I'm sure it was for like that for a lot of people. But once, like, I would wake up at 5:30, finish my workout by 7:30. I was just waiting to come to office, and no matter what shit was thrown to me that day, I would take it in my stride and kind of deal with it. And I'm not saying that it's hard, it's easy to kind of get there. Even now, like people, I have my bad days. There are days I don't work out, right? And then I feel like shit. And that is very natural to kind of slip back into that state. But as long as you're making sure that at least you're there 70-80% of the time, I think you're doing a good job of it, right? Another example of things that I've done is like, so the last 2 years, I've stopped working on Saturdays, right? Like you need some downtime. People need time with their families. I have three kids, right? And the only time I really get with them is on the weekends, because morning I leave and they go to school, and the evening by the time I'm back, they're kind of asleep, right? So it's really the weekends that I get time. So I stopped working out. I stopped working on Saturdays. I get my long workouts in Saturday, Sunday, and then I spend time with the kids, right? Backseat, my social life, my friend life has taken a backseat, and I'm okay with that. That's kind of the state. Something has to give, right? You can't juggle all balls.
Gaurav, downsizing the team, that's a pretty big challenge, right, as a founder.
Yeah.
And once that's a pressure on the team also. How did you cope up with the management of the team and handling the team, emotions, all those
Yeah.
sort of a thing, please?
The first thing that I will say is if you're doing it, do it one time and finish it, right? Don't do don't do one round now, 6 months later another round, 6 months later a third round, right? That creates terrible morale in the company. Do it one clean sweep and say, okay, I have to do this for the company's sake. I don't like to do it, but I'm going to do it, and make it one clean exit, right? So don't create a repeatable pattern of saying, okay, I'll do a little bit now, a little bit later. That is the worst thing to do. The second thing is that we never did, which I think is again right, is we never asked people to kind of reduce salaries. We had rather said, okay, please leave the company, go find a job somewhere else. We'll help you find a job. But don't have people who had reduced pay packages, take a 20%, 30% haircut and still work in the company. Morale just takes a big beating again, right? Third, just be very honest and do it very clean, right? Saying, okay, unfortunately, these are the guys we have to let go. This is it. Be fair in how you do the exit. So give them insurance, health insurance, a decent kind of severance package. Obviously, help them kind of land on their feet. So we obviously did things like recommendations, try to find as many of them jobs as possible, and ultimately just be transparent with people, right? Don't tell anyone that that you are here because you are not a good performer, bad performer. It is because the company needs to do this, and unfortunately, you're on the list, right? There's no kind of favorites and stuff like that. And just be fair and say, okay, this is it. I'm sorry, I don't have a choice. This is not the position I would have liked to be in. But given that we are here, I'm going to try and be as fair to you during this hard time as possible. And what else kind of sent a signal is both founders, Shashank and I, for almost 2 years, we didn't take a compensation ourselves, right? Because I find it very weird when the company is going through a tough phase, you're doing layoffs, and founders are still kind of, taking in a hefty salary and stuff like that. Obviously, you have to kind of make some compromise. You need a life to move on, and you need sustenance as well. But like, it's weird if you're still taking a high salary package when you're actually laying off people. So we actually took the hard step of us not taking compensation as well for a while.
Gaurav, like you are one of the founding members of DLAI. So I wanted you to share a little bit about what is DLAI and what are some of the advantages, like the cohort, or maybe not only DLAI or any kind of a body which people can get, and but let's say advantages you have found.
Yeah, I think if you're in a regulated space, right, it's important that you kind of take a leadership, especially with the regulator, to say that you are serious about creating self-regulation as far as possible, right? In fintech, especially, we have seen a lot of nonsense happen in the last 2, 3 years. Chinese lending apps, this, that, people kind of not following right collection practices, right? So it's been terrible in many ways, right? People taking a lot of regulatory shortcuts, doing loans without KYC, all of that we've seen, and rightly so. The regulators had to step in, and DLA was our attempt a few years ago to preempt some of this. So I think to some extent we were able to catch it and get a lot of our members to say, hey, this is the code of conduct and the ethics that we are going to follow. And some people did not want to kind of sign up to that, and that's fine. But the idea is always like lending, financial services is going to be a regulated industry in our country. And so you might as well kind of accept that early on and do your part to kind of stay regulated, right? And which means for us, obviously, was being an NBFC, but also setting up DLAI, which was to show to the RBI that we are a bunch of serious people who are ready to follow regulation, and this is our best foot forward. So I think just don't shy away from regulation, whether you guys are insurance, lending, mutual funds, whatever you do, right? Like if you try to take shortcuts now, it is going to come back to bite you in the ass.
Interesting. And Gaurav, like as DLAI, have you found it easier to, let's say, I don't want to say lobby, but probably to talk to RBI or other industry bodies, and
I think
get more of a sense of what they're
what has
thinking? Yeah.
become easier, again, I would say maybe not talking to RBI has probably not been the easiest, but I think getting all the lenders on the same page, right? Making sure objectives are aligned because everyone has their own different objectives. So you then decide, okay, for this year, these are the one or two things that we will focus on, right? I think getting there itself as an industry is quite a big win.
Yeah.
And the second
Correct.
piece can come actually, how do you interact with the regulator and stuff like that. But the first piece is just getting everybody on the same page. And with like 30, 40 competitors, that's never an easy task to do.
Hey, Gaurav. So you started the conversation with focus. You said like, I mean, remain focused. So we as a company keep on getting a lot of opportunities. I mean, because our advisor group or our investor group is more Southeast Asia. So they keep us kind of opening doors, maybe in Indonesia or Sri Lanka, which are smaller markets, easier to get into. So you don't need kind of an investment that you would need here in India. So our focus would be to run Vietnam as a as an incubation market, and then bring it back to India, the whole model that we have designed, work with IRDI, work with the regulatory body to kind of approve the licensing and all. So, but I mean, dragging into multiple markets is an opportunity and a challenge at the same time. Would you recommend a focused approach or
See,
an
if you
opportunity?
yeah, if your business is such that whatever little bit I understood of your business, if your business is such that you're building a pure kind of SaaS model with just a data play and an integration that other insurance people can use, right? And it's purely kind of tech without much regulation, underwriting that you're doing yourself. I think that it's fine to kind of go slightly wide on the geographies and attack 3, 4 different geographies at the same time. But if you're going to go deep in each market like Vietnam and go into India and actually think about doing it yourself and working with IRDA and getting licenses and stuff like that, then I'd say take it slow and maybe do one thing at a time. Right? It really depends on the model that you're actually trying to create.
I mean, we North Star would be to be an insurance company, and so you sometimes get licenses that are available in Indonesia, maybe available in Sri Lanka. Then an acquisition cost is not that higher, right? So I mean, you would want to maybe go Sri Lanka, acquire a term insurance company, and maybe run there, rather than wait for IRDA for 2 years to change the regulation and then issue an
Yeah,
insurance.
and so that's the answer. Then, and if you're able to, if you want to be that insurance company and you want to do full stack, then you're right. Then regulation in India is not going to be very friendly for you for a while, right? Especially with IRDA, RBI, all of that stuff. So maybe the right answer is do Sri Lanka, prove the model in Sri Lanka, Indonesia, where it is easier. And then once you get to the size and scale, come to India, right? So uh, it also depends as to what you want. Are you ready to play the waiting game in India a little bit, right?
Yeah, correct.
I
Yeah.
would say the IRD actually has, at least what I've seen in the recent past, has been pretty kind of progressive,
Yeah,
at least in
correct.
the last couple of years, right? So this is I don't know that insurance and IRDA space very well, but uh, my gut would say if I was in your position, I'd kind of, if I wanted to build a full stack insurance company, I'd find one market which is sizable. I'm not sure Sri Lanka is a sizable market.
Yeah,
Indonesia
correct.
clearly is. Go there because at the end of the day, you also want to build a big business, right? You don't want to be serving a few 100,000 customers.
Thanks a lot, Gaurav. I really, really, appreciate you taking out your time. I disturbed you again early in the morning.
No, perfectly fine.
Just to make sure you don't miss.
No,
And
perfectly
thanks a lot
fine,
to
man.
Rajat.
Yeah, no, happy to
Thanks a
help.
lot to Rajat also, Yeah.
No, happy to be here, and like I'll put my email on the chat. Like, feel free to just email me. I'm happy to kind of. I think it's important as an ecosystem. We are all there for each other. So to whatever extent I can help, I'm always available on email, WhatsApp, whatever it is. So lovely to meet you guys. If you're in Bangalore, feel free to drop by our office as well. And if you're not in Bangalore, you're going to pass our office to get to the airport because we're on the way. So do drop by for a cup of coffee whenever.